Greetings and welcome to another edition of the Ad Astra Kansas Money Talk podcast. I'm Joe Blubaugh, your host, joined by Mark Johnson and Bob Schwartz, who normally here is with us. He is still on vacation, so we're going to do another episode without him, but I do believe he will be back for our next episode. Yeah. If you're watching us on YouTube, we'd really appreciate it if you give us a thumbs up and subscribe. That would be great. Same thing with anywhere you get your podcast. We would really appreciate that. That way we can let you know when we put a new episode out there. And Mark is with Schwartz Investment Partners, and they have offices in Victoria, Kansas, and Silver Lake, Kansas. And if you'd like to learn more about what they might be able to do for you, you can find them on the web at schwartzinvestmentpartners.com. And we're going to talk about what I think, when I think of working with somebody like yourself, Mark, I think of, there's the investment piece of it, but maybe more important, at least in my mind, is how do we come up with a retirement plan? How do we make withdrawals? How do we do that as efficiently as possible? If you've watched the show before, you've heard us talk about inflation and how that's such a big risk for retirees. For me personally, one of the things I've always thought of as the biggest risk in retirement going forward is taxes. So we're going to talk a little bit about retirement withdrawals and specifically focus in on ways to do that, and then with, of course, a big look at the tax piece of that. So yeah, maybe you can get us started. Talk about if you got two retirees with about the same income or the same portfolio, they can have very different
withdrawal plans.
Withdrawal plans, yeah, absolutely.
Yeah, and so most people, our focus is save for retirement. That's all we've ever worried about was, are we going to have enough money to retire? And then all of a sudden there comes a day where you do have to actually withdraw that money to live on in retirement, and people don't have a plan for that. And it's easy to go online and be like, okay, here's kind of what I need to do, but there's really no cookie cutter option for every single person. Everybody's different with their different accounts they have. If you have a pension, if you have 401k, your traditional IRAs, your Roth IRAs, everyone has a different financial picture. And so having a real withdrawal strategy to fit, to be the most tax efficient as possible is really important, because taxes can just kind of be a silent killer in your withdrawal, formula if you let it.
Okay, so you brought up the different kind of accounts. This might be a good opportunity to talk about what are some of those different accounts that are available for people that they might be drawn from in retirement.
Yeah, so the most common ones are probably your work retirement accounts. If that's your 401k, it's your simple plan, anything like that. Then you have, your traditional IRAs, your Roth IRAs. Those are kind of I would say the most common ones that we see. Well,
and then let's go back to the work ones, because with the introduction, it's probably been a decade or so ago now, but you can have Roth versions of that as well. Yep. So you can really have a blend there. And then let's not forget about brokerage accounts.
Yep. Yeah, exactly. Non-retirement account, your brokerage account, your individual account, that I think still some people don't understand the power of having a taxable account in your portfolio, where you have a lot of control over without penalty.
Let's take a second, because I'm always intrigued by that. I didn't, as I save for retirement, the brokerage account was always kind of, I don't need that. I've got these retirement accounts here, and retirement accounts are wonderful. They have such great tax efficiencies built in, but one of the drawbacks, and there are some nuances to this, but for the most part, you have to be 59 and a half before you can touch that without penalty. And yes, I get it. There's Roth. You can withdraw some of your contributions on the Roth, or if you retire from the company, there's a rule of 55. There's some different things there, but for the most part, 59 and a half, which, most of us don't think we're going to retire before then, but Some people do. And what's great about a brokerage account is that is money that you can invest. It's a vehicle very similar to a retirement account as far as how you can invest with it, but you can start drawing that money out as needed.
Yeah, whenever you need. And you can, even if that's something you want to use as a savings account, we have tons of people that use a brokerage account to have their cash on hand for projects while it's still getting, maybe a better rate than they would at the bank. Right now, for example, you could trade CDs and treasuries and, get a little better rate than maybe your high yield savings account at the bank or, whatever that is at the bank. So that's really powerful, as well as just, hey, you want to invest in there because you have extra cash and you want to make more money.
Yeah, and then the other thing that people don't think about with the brokerage account is there can actually be some tax advantages for a brokerage account. Now you mentioned CDs and so cash and cash-like equivalents, you're still going to pay ordinary income tax on those things. But when you get into securities and certain things within that brokerage account, you can actually, if you hold them for over a year, get into long-term capital gains taxes, which are tax advantaged over normal income most of the time.
Yeah. You have that. You have the power of those. You have the power to create a low basis. You have the power to have a higher basis, which we'll talk about later. You have to talk about losing money and being able to tax loss harvest too, which doesn't sound great or anything because you've lost money, but you're able to have that ability in that account, which is powerful in its own. Yep.
Yeah, I mean, nobody is going to win all the time.
Yeah.
So it is nice to be able to take a loss and use it to your advantage then. So let's talk a little bit about withdrawals specifically. And we were talking before the show, and you said the first thing that we need to focus on is these RMDs, required minimum distributions. You'll hear RMDs, but that's what it stands for, required minimum distributions.
So we'll put a caveat on this first this is when you're over 73.
Correct.
So,
yes.
so we've hit this age. So if you're under that age, your retirement strategy, you have to kind of skip this step for now.
but I would argue it is important that you keep in mind that they're coming.
Yes.
Because that could make a huge difference of where you want to draw from in the years leading up to. And in fact, it gets really nuanced here, but there is that time from when you stop working to the time where you start drawing Social Security. You might have a gap in there. And that might be an excellent time to start really thinking about those monies that haven't been taxed yet that might get hit by those RMDs later down the road. So I agree with you. And then the other thing we need to talk about is it's 73 today.
Yeah, and
for the majority of people that are my age and a little bit older, it's going to be 75.
Yeah, exactly.
And anybody younger than me, it's definitely 75.
And so I just didn't want somebody that was 67 or 68 thinking they needed to take an RMD yet. So
no, not yet.
Don't start doing that. But if you are old enough, especially, I will say, put one thing on before we get going too much. If you're the age where you can start taking QCDs, that's actually a good time to start thinking about your RMD strategies. And if you want to be able to, take some of that money so you don't have to take as large of an RMD, that's something that you should think about if you're charitably inclined.
And a QCD is a qualified charitable distribution.
Yep.
Once again, we're getting into a lot of detail and a lot of nuances here, but 70 and a half you have to be to do a QCD. But basically what that does is you can, if you're charitably inclined and you were going to donate money anyway, you can actually, instead of taking a distribution from a taxable account like your 401k or your IRA and being taxed on it, you can, and then you send it to the charity. You can actually skip that step and send it directly from your account to the charity. They don't get taxed on it. You don't get taxed on it. Everybody wins, and it can satisfy your RMD if it's big enough.
Yeah, and I cannot tell you how many times I've met with people or just talked to people that I know in life that they're older and they give money to their church every week, but they don't do it from their retirement accounts. I'm like, why not? You give that money anyway. Might as well not get taxed
they're
on it
getting
in your
taxed on
RMD,
it.
you know?
And then they're giving it away.
Yeah, you know,
Right.
and so that's just a really easy thing. And like I said, it can lower your RMD as you know, so you're don't have that huge RMD when you're 73.
And I feel like we've kind of skipped over an important thing. RMDs are the government's way of forcing you to take money out of those accounts that haven't been taxed yet,
Yep.
so that way they can recover their taxes.
Yeah, they're called
So-
required minimum distributions. So we'll start there that's the first step. And in your withdrawal strategy, we're going to start with your RMD because you have to take it. So we're going to start with the thing that you have to do. So this is with your traditional IRA, any sort of retirement plans that are not Roth, your 401k, whatever that is, and so these are mandatory distributions you have to take, and you do have to pay a penalty if you don't take them. So that's where we start with the withdrawal strategy is, do we have an RMD? How much is it? What are we going to do about, how much are we want to give away through QCD? How much are we taking and putting in your bank account and paying the tax? So that's kind of that first layer of withdrawal strategy. The next set is then using your taxable accounts, actually. So using your brokerage account as so let's say you need a couple extra $100, maybe $1,000 a month, whatever that is. We would move then onto your taxable accounts. And then we look at your taxable accounts and look at what you own in those accounts and decide, what has a high cost basis. Okay, higher cost basis, lower tax hit because we don't have a massive gain. And those are the things we would sell first in those accounts to create that cash available. In a lot of these accounts, for example, we probably have some cash sitting there just for this example right here. We probably have some money set aside so that we're not having to sell. But if we do, we're focused on those higher cost basis assets first. Moving into the lower basis as we go is if we need more money. Because, there's some people that might be investing so long that they have a cost basis in some great company that's like $10 and it's worth $1,000 a share now. And that does happen.
Yeah, absolutely.
Very, very regularly. And so if you can imagine, selling all that at once could create a pretty hefty tax bill.
Right. Now, once again, it can be tax advantaged. It
Yes.
all matters. But if they've held it for over a year, a capital gains tax on that, let's say they're in the 22% or 24% bracket, they might only have to pay 15% in capital gains taxes. So it can be a little bit of a tax advantage, which is why that account, once again, is so powerful.
Yeah. So having the flexibility in your brokerage and your any individual money is super powerful. And like we talked about, having some liquidity in those accounts can be great. Having some money ready to go in either money market, CDs, bonds, to where maybe a year or two of money, to where if let's say we have a big decline, for example, like right now we had a big market shift in the last couple days.
Mm-hmm.
Like we don't really want to sell right now. If we need a withdrawal, we don't really want to sell right now.
Right.
We'd rather use that cash we have on hand. And this is a great example of, I don't really want to sell these great companies that we think are going to be fine in the long run. We want to make sure that we're using the cash that we have on hand for these withdrawals.
And that's kind of called that bucket strategy,
Yeah.
where you have different buckets of money that you're going to pull from at different times. And once again, it all fits into this big plan, but the whole idea is maybe you have a couple of years worth of expenses sitting in cash. That way, if there is a big downturn in the market, let it set, let it recover, focus on the cash. Once it does recover, build that
Yep.
cash back up.
Exactly.
Yep.
But yeah, so then we go from these taxable, if we still need money, we're going to go to our Roth last. This is definitely, we do not want to take from here unless we have to. So if we do need more money, we're going to go to our traditional first. We're going to pay the taxes on it. We're going to go to our traditional IRAs or traditional 401ks. We'll pay the taxes for it. Just like this is, at this point, this is over our RMD, what we've taken. We're taking a little bit more. We're going to pay that tax, get that money, because it's going to lower RMD for next year.
Right.
And so then if we run out of that money, then we would go to Roth. We want to save that for last because it gives us our maximum long-term compounding value in those Roth accounts.
Yep. So the thing about RMDs, they're all based on life expectancy tables that the government has. And as you get older, they get bigger.
Yep.
And if your account keeps getting bigger as well, because maybe your return is more than your RMD, your RMD is going to get bigger and bigger and bigger. So what you're saying makes a lot of sense.
Yep.
If you need additional money, let's go back and draw that down some more. Even if there are some strategies out there where maybe you even draw it down a little bit more than what you need just because you're in a lower tax bracket right now.
Yep.
And then
Yep.
you can take that and put it back in your brokerage account.
Yep.
Or, there are some Roth conversion, potentials. Obviously, those are very, based on the
Individual, yeah.
Right. But
Yeah,
lots of different things. There's a lot of moving pieces is what we're
Yeah.
seeing when it comes to retirement withdrawal strategies.
And there's a lot of people that, they take their RMD and they put it right back in their brokerage account, and they don't necessarily say they have a bunch of pensions and they have a bunch of secure income coming in. That's what I'm saying, where the puzzle pieces are completely different from every person.
Well, yeah, and let's take a second because we have a little time to talk about this, and it's something I'm passionate about. There are two accounts that we've mentioned that are just amazing for legacy giving too.
Yeah.
If you have children or you have somebody in your life or some organization in your life that you want to give money to at some point in once you're gone, the brokerage accounts are amazing for that because once again, if you own securities in their different assets, some of them can get a step up in basis on your death, and all of a sudden, so maybe you did have one of those tech stocks that you bought for pennies on the dollar.
Yeah.
Once you pass away, it steps up to the current value of the day of your death, and whoever inherits those doesn't have to worry. All that tax liability wiped out.
Yep.
It is an amazing legacy giving. So it's another reason why that might be one you want to wait till the end to use when you need it, and if you don't, you can pass it along.
Yeah, I feel it with Bob not being here, that's very much, the farmer mentality. We want to have that land stepped up to our heirs. Same thing with our brokerage account, have that stepped up to our heirs to let them enjoy, this, with that stepped up basis is a pretty incredible gift if you have it. So,
right.
Yeah.
And then you talked about using the Roth last because once again, you want all kinds of growth in there because that growth isn't taxed.
Yep.
And but it's also great for legacy giving because once again, it's not taxed. Now, they've changed the rules. You still have to take it out within 10 years if you give it to one of your heirs or to your family upon your passing. But
yeah, they want to get that money taxed somehow.
Yeah, but you've already paid the taxes on it, and the earnings aren't taxed. So once again, tax-free distributions.
Yeah, they just want to get it going into somewhere else. They want to get it. So, for example, Roth accounts are like the ultimate flexibility tool for retirement accounts. When we see people with a lot of Roth money, it's like, okay, well, we have tons of room to do what we kind of need to do because if you need the money, you got to take it out tax-free. If you want to give it, your heirs get to bring it, take it in tax-free, and then they get to do whatever they want with it. I mean, they could take it and, do whatever they need to, but really they could start that brokerage account, that we've talked about the power of. They could start their brokerage account with from this Roth that they've, have to take out every 10 years. It's just such a great, it's just a great account to be able to use for multiple things. And I don't know. So many people are like, are they going to get rid of that one of these days? And I sure hope not.
No. I've heard that for 15 years now. You take advantage of the Roths because someday they'll figure out what they've got. But I've also heard there's a pretty famous financial advisor that is like the king of Roths. Ed Sloth is his name. I'm sure you've heard of him. And he's like, he doesn't think they'll do away with it because politicians are all about the immediacy. They need money now.
Yeah.
And they love Roths because you're paying taxes
Now,
now.
yeah.
And you're not deferring. So they actually like it. They actually like the Roth conversions because you're paying taxes now and they can get that money. So there are people that think it will never go away. But if there's one thing I've heard in this episode so far is it's good to have a variety of accounts.
Yeah.
So you have all that flexibility. Where you get into a problem is when you have, all your money is in the tax deferred. That tax bill is coming. It's a ticking tax time bomb. But on the flip side, if you go through and have converted everything to Roth your whole career and you go into retirement with no deferred money, well, then you're missing out on some tax savings because you have a standard deduction every year. That's not taxed. You want some money in that taxable account because if you pay all the taxes in your working years, you're paying a lot of extra taxes over here that you could have got for free in retirement. So it's really nice to have a full blend.
Yeah. Yeah, and there's so many people that don't understand how, there's a lot of people who are like, oh, I have my 401k at work. Yeah, you can have your traditional IRA. You can have a Roth IRA, separate from work. I can? Yeah. That is one of the most common things that people don't understand is you can have your individual Roth that you can be maxing, or if you make too much money, which there is too much money that you can't have a Roth. But so many people could benefit from getting that right now, $7,500 put away into that Roth every year. And if you start that even in your 30s, by the time, if you could do that all the way to retirement, I mean, your Roth IRA is stacked. It should be if you invest anywhere, sort of prudently.
Right.
It should be a pretty amazing tool for you in retirement. So just know that if you're listening to this and you're like, I don't know if I'm taking advantage of all these things. Well, look what you have. And if you worked for your employer a long time, they should offer a Roth option in your retirement plan now. Pretty much all brokerages now have, or retirement companies that we know of, have a simple 401 or a simple option or a simple Roth option or a 401k Roth option. They should have that option for you. So if you're not aware of that and you don't have any Roth money and you want some Roth money and you have a 401k, make sure that you're looking into that.
And obviously every situation is different, but as a general rule, definitely look into Roth.
Yep.
Even when the Roths first came out, there was the mindset was if you're younger, do the Roth. If you're older, you don't have enough time to kind of make up the difference. And I think that has changed over time. There are a lot of people that I listen to that say Roth 100% of the time, all the time. Doesn't matter your age, doesn't matter your income. Just do it because the flexibility and that growth that's tax-free. But do your own due diligence. But if you have a Roth option, definitely look into it. Even if you're a high earner and you like, that tax deduction of your tax deferred, just keep in mind that you're going to pay that tax at some point.
Yep. And there's so many great Roth conversion strategies now, especially for people, right near or right after retirement, where your tax bill is a little bit lower. Mm-hmm. There's times that you can still get Roth money, even if you don't have any, that if you're willing to do a little work on the Roth conversion, standpoint. But that can be confusing. So if you need any help with any of that, that's something we always are willing to do for people. And those are kind of fun projects to work on for people to figure out these withdrawal strategies, these withdrawal plans. We really enjoy doing that part of this job for sure.
Well, let's talk just for a few minutes. Let's go through the logistics because we've already kind of mentioned it a little bit, and we kind of have about 5-6 minutes left of the episode here. But we talked a little bit about the bucket strategy.
Yeah.
So 6 months to 2 years. I've even heard sometimes 2 to 3 years. The thought here is that there's a drawback in the markets, and your retirement account is very heavy in securities.
Yep.
And maybe you lose 20, 30, 40% in a market correction. Generally, history says that it will come back within 1 to 2 years.
Mm-hmm.
The whole thought is that, hey, instead of selling into that down market, let's have some cash set aside, so that way when that down market comes, you go pull from the cash and you let that recover.
Yep. Yeah, exactly. Having that money and money market, CDs, treasuries, even if there's some people that want to keep that money in their bank accounts. I mean, just have it as their normal savings account. There's people that it's really what is comfortable for you, for your, pretty much your cash bucket. I would obviously recommend keeping it in something where it's gaining a decent amount of interest.
Sure.
Yeah.
Because that's where the inflation comes in. If
Yep.
you're not at least trying to keep up with inflation, then you're losing money.
Yeah, exactly.
Yeah.
So, yeah, and then you have to keep if we're talking about the buckets, you got to keep refilling your cash bucket as if you're withdrawing from it. And so that's an important part of this too. Your medium-term bucket is your income assets, and then your long-term bucket would be like your growth. So, and so when we think about accounts, when you think about like the accounts that are in your Roth, is going to hold those long-term assets.
Right.
Your
Because you want them to grow and grow and grow, so
Yeah.
you get that tax-free growth.
And again, caveat, everyone's different. This is very general what we're kind of talking about. This is
Right.
what people would basically say is, yeah, use your Roth, be aggressive in your Roth, let those things grow tax-free. Your medium-term growth can be in your tax-deferred accounts. Maybe this is where your balanced funds or your dividend, your value investing, dividend funds can kind of be there in your tax deferred. And then your income stability assets are in your taxable, your cash buckets. And you can have a mix of things in all these accounts. There's no problem with that. But we're just saying in general, this is kind of rule of thumb. In those, say in your brokerage account, you do have those cash assets. But maybe you have some of those, things you've been buying for 20, 40 years that are still in there. That's totally fine to have those in there, but you do have your cash bucket available in that account as well. So, yeah.
Okay. Well, as we wrap this up, flexibility is, we've already hit on it, but it's worth repeating. Have a blend. Try not to, there's diversification of assets. We talk about that all the time. Don't put all your eggs in one basket. Don't buy one single stock and have it, and that's all you own. But you can also have diversity of your vehicles, your different types of accounts, and each one plays a very important role through the retirement withdrawal strategy. So if there's nothing else we've learned today, is try to have a mix of all these.
Yeah.
For sure.
And then the last thing I'd say is all these things are guidelines. There are some other, there's some scenarios that could pop up and mess up, the guidelines or not mess them up, but there's opportunities along the way. For example, some situations that we put down here where if you have some really high deduction years, you should use your tax deferred account. If you have some really high income years, you should use your Roth account.
Right.
If you have low income years, that's your time to do your Roth conversions. And then if you're pre-59 and a half, you have to talk about the rule of 55, which we talked about. So we've talked about those guidelines, but there are scenarios in here where we have to make sure that we're aware of, because there are opportunities along the way as well.
Right. And I think if you just look at an overarching kind of thought of this episode, this is not a easy cookie cutter thing. It's one thing to invest through your life, but when it comes time for the withdrawal, there are so many opportunities, and if you think on the opposite side of it, tripwires out there or hazards to people as they withdraw. They could be spending thousands extra on taxes or missed opportunities if they don't have a plan. And that's where you guys come in, you and Bob. This is what you do. And if you would like some help coming up with a retirement plan, and you don't have to be days away from retirement to do so. And in fact, it's best if you get out in front of it by a decade or so to set things up leading into retirement. These gentlemen can help. I'm pointing to Bob. He's not here. But he'll be here next week.
He'll be here.
But Bob and Mark, they can definitely help set up that retirement
Yeah.
plan. Learn more about what these gentlemen can do. We would invite you to go to their website, schwartzinvestmentpartners.com. Once again, thanks for joining us for the episode. Give us a like, a thumbs up, subscribe. We would really appreciate it. Have a great day.
See ya.